Hey there, it's Friday the 13th, year of our Lord 2022, and today I want to talk about structured notes, and also I want to show you a little update on the market. Last week I talked about the bull-bear market strategy. This week, today, Friday the 13th, we're seeing a pretty good rally in the markets. I don't expect it's going to last, and so I wanted to share a little bit of an illustration about one of the leveraged inverse ETFs that I put into the bull bear strategy. Also, I want to share a little bit about structured notes for those of you who don't know what a structured note is or how it works. So that's what's coming. Thanks for watching. If you're watching on YouTube, this will be posted at missionalmoney.com as well as bayrockfinancial.com. So thanks for watching. If you're watching on YouTube, please subscribe to the channel. And if you're listening in iTunes, well, thanks for listening in iTunes. Please leave a 5-star review. Let me know you're listening. It helps us get the show even visible and iTunes or anywhere that podcasts are played. So thank you, and I'll see you next week. I'm going to go ahead and hit the play button because I pre-recorded this, a couple of little clips for structured notes and for the leveraged inverse ETF SOXS. So check it out. It's all ahead, and I'll see you next week. Thanks for watching. Thanks for listening. Take care. Have a great week. Structured notes are, well, they're one of my favorite investment vehicles for clients and for my own account. So I wanted to spend just a few minutes and kind of go over or introduce you to the elements of a structured note. Now, I'll tell you this, structured notes are not for every investor. If you're not sure if a structured note is for you, just let me just say this: they look very good, and they are. I think they're very good, but they have risk. Just like any investment has risk, a structured note has significant risk. Now, like any investment, if you understand the risk and the reward, you can make an informed decision, and I'll help you do that if you're thinking that a structured note might be right for you. But this video, this post, is really just to introduce you to the idea for illustrative purposes and for the purpose of just helping you understand it. It's educational. I'm not trying to sell you anything. But when I check out a structured note, or when I want to learn about an investment product or an investment anything, basic information, I just go to Investopedia, which is a great source for information. And I found this video. I'm just going to hit play. It's a 2-minute video, and I'll leave a link to this page at Investopedia with this video. So I'm just going to hit play.
Structured products take a traditional security and replace its usual payment features with a non-traditional payoff that's derived from the performance of an underlying asset. Essentially, structured products offer retail investors easy access to derivatives. They're closely related to traditional models of option pricing, though they may also contain other derivatives such as swaps or futures. They're accessible to retail investors just like stocks, bonds, ETFs, and mutual funds. They offer customized exposure to hard-to-reach asset classes, making them a nice complement to a traditional portfolio. For example, ABC Bank issues structured products in the form of notes, each with a notional value of $1,000. Each note is made up of a zero-coupon bond and a call option on an underlying stock. It matures in 3 years. On the issue date, the buyer pays the $1,000 face amount. The zero-coupon bond guarantees the buyer will receive the $1,000 principal back at maturity. The call option will have intrinsic value if its value at maturity is higher than its value when it was issued. Structured products appeal to many retail investors because they offer the ability to customize a variety of assumptions into one instrument. For example, a rainbow note is one that offers exposure to more than one underlying asset, while a look-back instrument bases the underlying asset on an average of values taken over the note's term. Structured products commonly lack liquidity due to their customized nature, and returns are often not realized until maturity. The issuer's credit quality and pricing transparency are other risks the products pose.
So there you have a pretty good overview of what a structured note is and how it works, but you really don't have any clue about the risk involved in any specific structured note. So what I'm going to do in the next segment is I'm just going to unpack a pretend structured note. It's very closely related to one that's actually available today for, today. When I say today, here's an important piece of information about structured notes. So at least in the world I work in, structured notes become available through different brokers, and these brokers are representing banks like Morgan Stanley, Goldman Sachs, Citi, Bank of America, the list goes on and on. These investment bankers bundle these structured notes, like the video said, based on derivatives, based on options, based on different indexes or different specific niche markets. So there's a whole host of ways that a structured note gets put together. But we, in our business, in this business as investment advisors, we can collaborate with friends of ours who have a certain desire to put together a note, and we can mark up or put together a note and sell it to our clients or place it in our clients' accounts. We don't really sell it. I'm a registered investment advisor, a fiduciary, and so there's no commission on sales. I just want to get my clients' portfolios to make money. I want my portfolio to make money, and that's why I like structured notes as a piece or a sleeve in a portfolio that's part of the fixed income sleeve. And yes, it has risk. So I would never even place this in a client's account if I didn't know that the client was comfortable with the risk. And I have to be comfortable with the risk. So what I'm going to show you in the next segment is basically a note. Just understand that it's put together, this note, this package is always put together by an underwriter, an issuer, a bank, an investment bank like Morgan Stanley or Goldman Sachs or Citi. I think this one is put together by the Bank of Montreal. I'm not sure, but it's a pretend structured note, and it's based on Tesla. And it's based on Tesla, and I'll show you in the next segment how it works. But I want you just to get ready to learn a little bit more about a specific example of a structured note and how it works, and why I think it might make sense for a lot of investors who don't really even know what a structured note is, how it works, or how to get access to it. So stay tuned for the next quick segment on a specific example of a structured note using Tesla. Okay, so here we go with a Tesla structured note example. And again, this is for illustrative and educational purposes only. I went ahead and posted this at bayrockfinancial.com. I'll also post it at missionalmoney.com for the podcasts. This is going to be included in this week's podcast episode. So if you're listening in iTunes, thank you very much. If you're watching on YouTube, well, subscribe to the channel. Otherwise, if you're listening, you're not seeing the image. You can check it out. Check out the video. Check out the post that I'm looking at right now at bayrockfinancial.com. So I got a picture of a vehicle that is a $100 bill going into the gas tank. Why did I select that picture? Well, gas prices are up, and I had that picture handy along with this picture with another $100 bills going into your gas tank. So this segment, this video, this post is just to illustrate what a structured note is. So I've created a dummy sample based on an investment banker called Morgan's Stanley Cup. So that's not a real investment bank. Morgan's Stanley Cup is not who put this together, because this is a pretend example. But this is kind of what it would look like if I were looking at a structured note to consider for my account or one of my accounts or one of my clients' accounts. So this one is, it pays it's a 2.5 year structured note. So it matures in 2.5 years. And in the meantime, it's designed to pay a 20% quarterly distribution. So that's 20% a year, which would be 5% each quarter. So if you put $100,000 into this, you would get $5,000 in the first quarter, $5,000 in the next, $5,000 for 2.5 years. However, this is the AutoCall. You see the AutoCall right there. That means that the issuer, Morgan's Stanley Cup, can call this anytime they want after the first, I think it's after the first quarter, automatically, initially. So the initial quarter, it pays the initial quarter. After that, they could call it. And that's one of the issues, one of the things about these structured notes that you may not like. It's one of the things that makes more work for guys like me, because when it gets called away, we just have to go find another one to replace it. But in the meantime, I'm pretty happy with a 20% quarterly distribution. There's not a CD on the planet that will pay that. And the reason I said CD is because this is not a CD. A CD is guaranteed by the FDIC, the Fed, and this is not guaranteed. There's plenty of risk in this, but let me explain. So it says 20% subject to Tesla closing above 60% of initial. What does that mean? So let's take a look at a Tesla chart. I'm just going to jump over to my Tesla chart and see if I can find it. Give me a second. So I'm opening my Tesla chart. Now this is a 6-month chart, I believe. And so, whoa, 60%. That means this note will pay as long as Tesla isn't below 60% at the time that we issue this note. So let's look at a max. This is Tesla. This is a max chart. And you can see that Tesla has dropped quite a bit in this recent nasty market. So it's one of the reasons I like this idea from Morgan's Stanley Cup. If it were actually available, I would buy this, because with Tesla down as much as it is, and now I think we're on a 2-year chart, so the chances of Tesla going down 40% from here and staying there, I'm not even sure what that number would be, but it would be a pretty dramatic downturn. And if you notice, Tesla is already almost, that is the 3 standard deviations below the mean, right? Not quite, but that's what that Bollinger Band represents. It's 3 standard deviations. So for that reason, I might even like to buy Tesla, but I wouldn't put Tesla in a client's account. Honestly, I wouldn't buy it in my own account, because just too much risk. But and it costs too much to buy. It's a big ticket stock. But I like this, so I'm getting 20% as long as Tesla stays above 60% of the issue when this gets issued. So does that make sense? Hopefully that makes sense. So that's the principal barrier as well. In 2.5 years, if Tesla is down 50% from the time this is issued, I'm only going to get 50% of my money back. So if you bought Tesla stock today and it was down 50% when you 2.5 years from now, that's how much value you would have. Your Tesla stock would have lost 50%. So this one is similar. If Tesla goes down 50%, you're only going to receive 50% of your principal in 2.5 years. In the meantime, you're still going to get 20% a quarter. So, I mean, that risk profile to me makes a lot of sense. So we've got the interest barrier, the principal barrier, and the coupon. So in other words, this isn't going to pay a coupon if Tesla falls more than 40%. The coupon, the payment, will stop until Tesla gets back above 60% of the issue price. So that's how that works. So if you just look at a couple of charts, again, it makes sense to me that this is a pretty good risk profile for a structured note. And so Morgan's Stanley Cup, Tesla, let's look at the terms again. It's a 3.5 years, 2.5 year, 2.5 year Tesla structured note. And that's kind of how it would work. So if you scroll down the rest of the page, I included some specific examples of how this Morgan's Stanley would work. For example, if Tesla's down 41% at maturity, the note will mature at 59%, meaning if you put 100,000 in, you're only going to get 59 grand back if Tesla is down 41%. If Tesla closes below 60% of initial at maturity, the investor realizes full downside, and that's what I just said. Let's see, if it closes below 60%, you'll receive 0 annualized coupon for that period. So 0 annualized, that period is quarterly. So if it's 60% down at the quarter, you get no coupon while it's down. If it closes at or above 60%, you receive the relevant annualized coupon for that period, which is quarterly. So you receive a coupon of 20% if the closing value of Tesla is equal to or above 60% of its initial value on observation day. That's the day that they pay the distribution. So that's pretty much it for my little example. I want to thank Investopedia. I used your tons of great material at Investopedia, so there are links in my post back to Investopedia. So much great information there. I would encourage you to check it out. So one more thing I wanted to share before I let you go in this podcast is in this episode. This is going to be an episode. So in the next segment, I want to share just a little bit of my observations about an inverse leveraged ETF called SOXS. I shared last week about the bull-bear strategy that I'm working on, and we're getting to that point where some of the shorts may come into play. It's right now the market is so oversold down near the third standard deviation. I would never want to short anything at this level, but when we get to some higher levels, I'm going to be, in my accounts, I'll be shorting some things. I'm assuming we're at least getting ready to go into a bear market. We will see. I do not have a crystal ball, but check out the next segment, and I'll see you next time.